Welcome back. You are listening to another episode of the Keep the Change podcast. And in this part 2, I've got Phil, my business partner from Next Advisory, here again to get through a bit of Q&A, mate, as to the things people out there in the Keep the Change community wanted to know about buying a business. So I haven't shown you these questions, so hopefully you know all the answers to them. If not,
put me on the spot.
Yeah, do what we do at Next Advisory and just make them up. Have you got ChatGPT on there?
Yeah, I'll be able to dial it up.
Yeah. But if you are just coming across this episode, then know that we have done a part 1 where we go through some of the basics of buying a business, and that's going to help people get up to speed with what we're about to talk about. So if you haven't listened to that, I would highly suggest going to listen to that first. But some of these questions we've sort of talked about at a high level, and I think we'll recover some of the things from part 1, but we'll also then be able to go a bit deeper. So the first one is basically, how do I find a business that I could buy?
Jeez, man, on the spot, I'm having to think and I need to deliberate. You know me. But look, start by just having a look at Trade Me.
Nice.
There's a lot, like if you want to buy a house, you want to buy a car, where do you go? You look at Trade Me. Maybe Facebook Marketplace, maybe not for a business, but there's plenty of businesses for sale on Trade Me. You can start by looking there to get a bit of a look and a feel of the types of businesses that are coming up and how much they're asking for. If you're really serious and you actually want to pursue the path, get in touch with business brokers. There's plenty of them out there. Start and form a relationship with some of them, and they will email you through the information memorandums, the IMs, of businesses that are coming up for sale. I think one thing to point out at this point is a lot of businesses that come up for sale actually wouldn't make it to a listing online, because the demand for good businesses for sale is reasonably strong, but the businesses that come up for sale don't come up very often. So you want to work on those relationships and start and let the brokers know that you're interested so they can add you to their database, and then you can start and get the information and go, these are the businesses that are coming up for sale. The other way would be just jump on social media and do a little cheeky post. Yeah. Hey, I've got a spare milli. I want to buy a business. Anyone want to sell?
Yeah, simple as that. Maybe it's the Herald, but I'm sure I remember going through, and you get to some pages sometimes where it just ends up listing 2 whole pages of different businesses for sale, and I've found it a bit intriguing. Of like, oh shit, look at all these businesses for sale. Yeah, I'm pretty sure Link run those ads.
Okay.
But Link, ABC, Kakapo, as we mentioned on the first thing, but Google, beautiful tool. Businesses for sale. Have a search.
The other really rash one would be if there's a business out there that you think could be something that you would like to run, and more often than not it's going to be an emotionally charged decision because you think, that's a cool business, I might like to buy that. Just be cheeky and email the business owner.
Yes. We're on the same page, mate. I was about to say, because I was just going to tell a story of a very wealthy New Zealander who told me that exact thing where he didn't even know that he wanted to buy this business, but he used the business and the background that he had, he knew that he could get that business doing probably 10x to 100x its production, and so just said to the business owner, do you want to sell this business? And they're like, we hadn't really thought about it. And was like, well, we'd be keen to buy it.
Yeah.
So just like anything, you can actually go out there and ask. So maybe start with what the sort of businesses that you may want to buy, because that's the first question that a broker's probably going to ask you too. I mean, yeah, they might just send you a whole heap of IMs to hope that you buy something rashly so that they collect the cash. But they're probably going to want to know, well, what sort of business do you think you want to buy?
And I suppose if anyone's familiar with, what you talk about on the Keep the Change podcast would be your target acquisition of Heartland Bank.
Oh, yeah, great business to buy.
That's the other way to buy a business, is just buy all of its shares.
Especially when its price is just tanking. And every month they have to do month end and just bleed the amount of...
the unrealised loss?
Yeah. And just then buy a bit more to try and dollar cost average. So, hey, maybe it's just buying shares for some people out there. The next one, mate, could take us down a rabbit hole.
Yep.
What is the main thing to look for in financial analysis? Now, I'll give you a bit of time to think about that, but I think it's pretty unfair to ask what is the main thing.
Ooh.
Because there won't be any one thing. But I guess if I was to hazard a guess, and you obviously know a lot more about this than I, but the key thing most people think about is, what am I going to pay for this? So then they've got to have a mechanism to figure out, well, is it actually worth that? Because most people wouldn't have experience to know, is a business worth what the vendor's trying to sell it for?
Spot on. The value would be the first thing, because obviously you don't want to overpay. But assuming that you've got past that value thing and you're starting to get into the due diligence piece, what was the question again? How did they word it?
What is the main thing to look for in financial analysis?
Financial analysis. Yeah, there's so much, because when I go into nerd mode as an accountant, there's a stack load of financial analysis that you can do in terms of ratios and percentage and stuff. I would go and familiarize yourself with some of the top ones that are available, and you can look online at what some of the top metrics are that you can measure, and it could be working capital ratios, gross profit percentages, net profit percentages. There's stack loads out there. There's going to be a top basket of, say, 3 to 5. That website, Investopedia, I don't know whether you've referenced that before on the podcast, but that's a great resource for really, dare I say it, because I use it, dumbing down, because I do need things in plain English of how or what certain financial things mean, and then putting it into context and using examples of, this is how gross profit is calculated, But, I would be looking, one of the key things in financial analysis would be trends.
Yeah.
And then you've got to overlay those trends with what's happening in the wider economy to go, well, is what's happening in the business kind of bucking what's happening in the overall economy, or are they kind of performing worse than the economy is? There's stack loads to it. There's not one key thing. It's looking at all of the different financial metrics and going, what's the story that these tell when we pull them all together? And are there any alarm bells?
Yeah, one of the fun story alarm bells would be that the old financials don't seem to match up to the information memorandum, nor then the GST returns. And then you got some real good alarm bells of, hang on.
Yeah.
Because I guess that's something that some people will do when they sell a business, is their add backs, right? Of, here's how the business performs, here's what you're going to see in the financials that get returned to the IRD. However, if you purchase this business, you may not have these costs because you may do things differently. Yeah. And there's some legitimate examples as well of, you might already have a commercial building that you rent out, but the lease is ending. But if you buy this business, it's going to go into there. So then a rent expense for you wouldn't be as important as it would be for someone who doesn't own a commercial building.
Owner's discretionary costs is another way that you could phrase it, in terms of the way that the vendor has structured the business. It might be a husband and wife, and they're running 2 cars through the company, so motor vehicle expenses are for say 2 cars, but you're coming along and it's like, well, I only need 1. Things like that. The other classic to watch out for is the international travel to all the overseas conferences.
Oh, the conferences, and promotional with the high-end customers.
Yeah, and back to your franchise association that you belong to, and you're going off to such exotic destinations as Las Vegas or the Gold Coast.
Yeah.
And, they're absolutely spending a fortune on these essential business things, but they're added back to obviously pump up the profit in the business, or it's essentially what's available as a return to any new owner.
Sounds like a true example, given that I've been to Vegas and the Gold Coast in the last 12 months. There's another question here, and then what other things, apart from the main things, right? But one thing that I loved about some DD you did last year was, I can't remember how the information memorandum worded it, but basically said that we've got a big social media presence, and you're buying that as well, or we're quite modernized in terms of the marketing and stuff we do.
Yeah.
And then, given that you know a lot about that, you're like, okay, well, we can check that. And then basically what you uncovered to then tell the potential purchaser, like, okay, well, if that's true, where's all of this?
Yeah, I remember that.
Yeah.
It was quite fascinating. And again, the IM will puff up the reality of what's going on, and that's the whole purpose of doing due diligence, is just to dig deeper beneath the hood and go, well, where's the actual facts and the data that are going to back this up? And your classic line, visibility is a fake metric of success, is 100% the case for so many of these online businesses where they might have tens of thousands or hundreds of thousands of followers, and there might be a stack load of engagement on there. That doesn't necessarily correlate or produce massive levels of income to the person that owns that business.
Yeah. Or even in some cases, there's no tracking set up. There's no pixels for retargeting. There's not a Google listing.
Yeah.
There's no Google reviews to back up the credibility that the business is saying it has in the information memorandum and all those sorts of things. And you can do some of that high-level sniff test outside
of the due diligence.
Yeah.
Absolutely. It's one thing, I think, in speaking in general terms, as much as this is about finance and the question was like financial analysis, I think equal weight should be put on the non-financial stuff as well, because I think that's one thing current business owners that are looking to sell neglect quite easily, is just how robust are their systems and processes. Have they got all their I's dotted and T's crossed to make sure that, hey, look, yes, we've got this customer database, but what are we doing with it?
Yeah.
How valid are all of these customers? We've seen ones where it's just, there is no, yes, we've got an email list and here's the list, and it's just punched straight out of whatever their email marketing platform is. And it's like, well, what other data are you collecting about these people and where's it kept?
Yeah.
Because the type of business that you've got, there's so many different data points that you could be capturing to then engage with them on other bits and pieces to then try and sell more to them.
Yeah.
Newsflash, that's why we're in business.
Yeah, or the classic, we've got over 2,000 customers. Great, can I get the database? Oh, well, yeah, hey, look, we'd have to run it out of something. And it's like, well, you're clearly not then using that for something else if you're not thinking about that. But I guess the simple thing that people could do if they were looking to buy a business is actually just make an inquiry of that business. I sent off an inquiry recently to an electrical business. 4 days later, no response.
Do you not know how to change a light bulb, mate?
Those fuses that they have in those boxes? I need to figure out how that works. Yeah, I tried YouTubing it, but
I think one thing that I've noticed you do with clients that come through nextAdvisory, particularly some of the planning clients, is you're a customer of those businesses. So you'll go and, like there's one that you're doing tomorrow, and their product turned up last week, I think it was. And then we've had other clients in the past where they're selling stuff online or whatever it is that they're selling, and you go through the process, because I think then with a customer's lens, you can then go, how easy was this? What were the bottlenecks? What were some of the problems? And I think if you're really interested in buying a business, be a customer of that business first. Yeah. Try it out. Did it work well? What didn't you like? Well, engage with the customer support, ask them some questions online, and then you're soon going to really see already under the hood, without even giving it away, how this business works and what the red flags are. And I think some of that stuff, which is the non-financial bits and pieces, can be equally, if not more, insightful than the numbers stuff.
Yeah, one thing that we often say to businesses that are growing, that are trying to build a valuable business is, okay, let's look at processes. And one of the final outputs of business is a Google review, as an example. So then we say, let's work backwards from the Google review then to how we ask for that, but how we even get to the point of asking for that. Okay, we'd have to do good work for them. How do we do good work for them? What does good work look like for them? And so then you can almost reverse it all the way back. But the older business owners don't necessarily think about Google reviews, and that's where some of these things could be a little bit all over the show, where there might not even be a Google listing, but it could be a highly profitable business. But you could then spot that as, there's an opportunity for us to be able to actually start wrapping some databases and some sophistication around this business as well, where you can instantly add value to it. It's not going to mean that your business is going to be worth way more a week later, but you start putting in those processes, and
I think a wider point that you've probably touched on there that people overlook is on that due diligence, it's a fact-finding mission, and you can do so much of that, a lot of it yourself, if you're prepared to invest the time, because Google is such a rich resource. YouTubers, just start and search the business and then read the articles. Has this business ever come up in the news before? Then go to the company's office. Who owns this business? Search them. What does the World Wide Web say about the business owners? Are they nice people? Are they got anything that's ever popped up in the news? We don't always do that with clients, but one came into the calendar a few weeks back, and I thought, something just didn't quite stack up. And I Googled I found the business. It was quite hard to find. Googled the business owner, and some not so cool stuff came up about them that was in the Herald. And I'm like, is this really a client that we want to have as part of our family? And the answer was no. That's due diligence. And it's just being curious and finding the answers and going, what can I learn about this business before even getting into the numbers side of things?
A couple of other things that I've seen you talk about, mate, is the makeup of the revenue. So you could be buying a business where it's very heavily reliant on one customer, and then you realize, okay, if that customer goes, there's 50% of your revenue gone. So little things like that where you're trying to figure out, okay, depending on the type of business that you're buying, where is the money actually coming from and what is the risk that it stops coming? It could be something that has great government contracts, for instance, but if the government changes, that might decrease.
Yeah.
But we've literally seen that where we had a business owner say to us, we don't need to do much marketing because 50% of our revenue comes from this client. And we're looking at each other like, shit, that's a big risk. Whereas they thought it was a good opportunity, or that's exciting and it makes our business safer. And a couple of years later, they came to us and the business had been sold, and that customer decided to leave because the new owner was like, we don't want to use you now for what we do. So bang, 50% of their revenue gone. So then they were back into hustle mode. So have a think about that, and then maybe even the age of the customers and clients that you have, because perhaps they're at the end of their life cycle. And then whether the income is recurring or not, or what is the average order number for a client. Can you continue to sell them different things, or have they basically brought everything that this business sells? So it looks great that revenue's been increasing, but these people who were a customer 4 years ago brought something again the next year, then in the third, then in the fourth, but they don't buy anymore. Did we do anything to fill up the first years?
The pot.
No. So the more you dig into this stuff and understand the business, then you're going to spot the potential risks, right?
Spot on. Yep.
Yeah.
Yeah. And that's all due diligence is about. And the financial analysis is what's the risk in behind the numbers.
Yeah. Yeah, I like that piece before about the facts versus the reality. So an information memorandum is just going to be output of information, which is all good and well, but like we say with all of our clients, your numbers are effectively an output of the actions that you're taking. So now we need to dig into the actions that you're taking to figure out how did you get these numbers.
Yep.
And sometimes numbers can look great, but they don't tell a true story of what's happening underneath there.
The other example that we did on a business going back a little while was sales were going up, but sales were going up at a rate that was lower than the inflation rate at the time. Right. And then when we dug into it on a volume basis, so number of transactions, it was declining. So, yes, sales are going up in dollar terms, but the output in units was going backwards.
But the information memorandum said sales continue to increase.
It's a growing business. Yeah, and rose-tinted glasses were on. I was like, this is all the fluffy stuff of this business. And it's like, newsflash, again. Yeah. The reality is no, that this business is actually going backwards because the order volume isn't what it has been. These people went ahead with their business purchase, by the way. But yeah, it was quite alarming. And it's one thing to see something in dollar terms and go, oh yeah, it's growing. Yeah, but actual orders, and if you had order growth and did it at an increased price, how much further ahead would the business be? So what's the lost opportunity that they've missed out on by ultimately tying it back to what's been a shite marketing campaign?
The piece before I forget that kind of covers a lot of this is we've actually got a checklist, right, of the things that you may want to ask before buying a business, or I think it's pages and pages, but then you've distilled it into
We've got a free downloadable business due diligence checklist. Email me or jump onto the Next Advisory website and you can grab a copy. And it's a condensed version of a much bigger one that we've got. So what we would encourage, and I think referencing back to the part 1 podcast, was there's a whole heap of learning and fact finding you can do yourself, and you can use that tool to start and tick some of those boxes. Then once we get involved and we get the information memorandum and then any other pieces of information that you have got as the purchaser through your fact finders, we will then customize a specific questionnaire for that particular business, and it is long.
Yeah.
And more often than not, it will scare the bejeebers out of the business vendor, the seller, because there's information in there that is being asked for that they haven't even considered. And in some cases, they will shit the bed. And it can draw the process out, because you're asking for information that they haven't considered. So then they'll give you the stuff that's easy, and then they'll procrastinate on the stuff that is like, oh, geez, I've actually got to put that together, and I don't really want to show that. So it's really quite interesting as you go through the due diligence process of what information is easily accessible and turns up quickly versus what isn't, and then ultimately what doesn't turn up. That in itself tells a story. And goes, well, we asked for this, but we didn't get this, so it could suggest this, 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 or this. And it's all stuff about risk. It's such a wide-ranging questionnaire. It's quite fun to put together.
And even a lawyer may have their own list of
lawyers definitely do.
Yeah. Next question, mate, is why buy a business instead of building from scratch? Which I thought was quite a good one to chuck in there, because those are two very, very different things.
Yeah, okay, that question threw me. I thought you were about to say why buy a business instead of buying a house. But is that question on it?
Yeah. I took that one out.
Why buy a business instead of building one from scratch? You're buying it because maybe you're afraid of hard work, because the person that started it's done it all for you. They've been out there with the shovel and carved their own path. No, I mean, all jokes and jest aside, that's essentially what the Goodwill is that you're buying, is somebody has gone through and learned a stack load of lessons that you're ultimately paying for. So they've had something that was originally a concept that they didn't know how the market would respond. They've put it out there and the market's gone, hey, yeah, shit, this is a really good idea. We want to buy that. And then word spreads because an influencer gets behind it. And then all of a sudden, boof, it's a unicorn and it blows up. Then people from all over the world wants it. And then they've had to solve problems in terms of how do we grow, and importantly, how do we scale this business over time and create something that fundamentally is an asset that we can sell. So you're paying for that hard work and those lessons.
Yeah.
Starting a business from scratch is hard, because more often, and I think a lot of people think, oh, I want to go into business, and they've got to come up with an idea.
Yeah.
And they just get stumped on what is the idea, and they just think. And I think starting a business is just looking at what's going on around you, and it's just solving sometimes the simplest of problems. I think you did a podcast, and it was on this one with that young kid, and he did that cutter thing. Did you talk about that?
Yeah.
On the podcast? Saw an opportunity. It didn't come up with the idea originally, but saw that there was an opportunity, built a website, marketed it. I don't know how many sold at the end of the day, but, at that time of year for wrapping gifts around Christmas and whatnot, smart, giving it a go. Going to learn some lessons. It might work, it might not. Going to learn about pricing strategy, supply, demand, that whole lot. So starting a business from scratch, there's a whole heap of financial and economic and just broader life lessons that you're going to go through. Whereas if you're buying an established business, as I say, you're getting those lessons, you're getting a degree of certainty and a return on that investment into the future, provided that you maintain a minimum standard or level of behaviour.
Yeah, I think starting a business has become fashionable because it's very easy to start a business in New Zealand.
Super easy.
It's very easy to set up a company. You don't even need an accountant to do it anymore.
Yeah, well, you don't even need a company to be able to have a business.
Yeah.
Like a business at the end of the day is just an idea, and you could be listing stuff on Facebook Marketplace or Trade Me or at a farmer's market on the weekend. And one of our really original clients at nextAdvisory did just that. Their business was selling their product at farmers markets.
Yeah.
And it got to a stage that it blew up that much that they then did a website, got onto that marketing side of things, scaled more, invested into plant and equipment to be able to produce more, expanded it into Australia, and then ultimately got external investment. And yeah, it's turned into quite the story, all from something that started at a farmer's market. And I know the weekend markets that you can go to every now and again, and I went to the one in our local neck of the woods recently, and I had the business glasses on, just looking at all of these stores and going, wow, this is where some of New Zealand's next success stories can start from. And sometimes people can look at those and just go, oh man, there's some shit here, but or there's some really good stuff for it. So they're there proving their concept. And it's not only just the product, but the pricing, how it's presented. They're going to get feedback and they'll take that on board, learn, adapt, and one day the right person might come along and boom.
Yeah, I saw a really cool business yesterday, actually, that is now 2 sites and leases 2 separate locations because the demand is there. But that business started as a gazebo at a market and it wasn't their gazebo.
No way.
Yeah, they had a sponsored gazebo that they could use to then put over top of them if it rained.
Really?
And they were testing the market to see, did people actually want what they wanted? And the market said yes.
Well, Botox at a market these days.
So now they have their own stores, but it started under a gazebo that they, wasn't even theirs. But I guess you've got to pick your path, right? And this is something that we went through because most people in our space, in the accounting space, would go out, when you go out on your own, you buy an accounting practice. It's decreasing now because the barriers to entry have changed and whatnot, and people go, well, you know what, maybe I'll just start one. But we made a conscious effort to build from scratch so that we could build the business that we wanted. And so then we've had to spend money on marketing and our time and effort to then win clients to do that and then to build everything from scratch, including processes. But a lot of people looked at us and were like, what a waste of time. Why don't you just buy a fee base and pay the debt back? And we just didn't want to do that. So it's sort of each to their own. But I guess the beauty is you can do it both ways. But it's a little bit harder to start a business that might need to be producing something in a factory, for instance, but there's already one established and you can go in, systemize it, digitize it, do it better, make it more efficient, make it leaner, etc., get it humming, bolt on some things on the side, add on upsells and things like that. What's the point of going and starting that from scratch when it might be very hard to do that when someone's got something that you could buy off them? I think a lot of us are scared of paying someone for their hard work. And you know what I mean? So we kind of have that, why don't I just start it? I could start it, which is cool because you can do that. But I think we don't like the idea of, I've got to give them $1 million and, they've built all the machinery and got it all humming and they've built out all the customers. So you have to think about what it is that you're buying. And I guess that brings us to the piece about the split between Goodwill and the rest of the business. And maybe that's a good type of business to explain the difference between what you are buying. So let's say a business that has a lease at a factory type setup and it's got equipment and things like that and then some IP and some customers that it sells to and the team and it's already pre-built out and you've got pretty consistent revenue. Is that a good example of a business to then work out the difference between what you're buying, tangible versus intangible?
Yep. Yeah. So let's say, to wrap some numbers around it, let's say this business is for sale for $1 million and the plant and equipment that you're talking about or the tangible assets could be worth, say, $400,000. And to manufacture their widgets, if that's what they're going to make, throwback to my economics teachers and whoever else back in the old days where it's like, where it's like we're making widgets.
I've always wondered what a widget is.
Yeah, me too, man. I've been wondering for a long time.
Yeah.
So we've spent $400,000 on some plant and equipment. They've got some stock of their widgets, and that stock's going to come in different parts. This is where we're getting really a little bit technical here, and there could be some raw materials, there could be work in progress, and there could be finished goods of said widgets, and the value of all of that combined could be, say, $200,000. So that's $600,000 of our $1 million that we've already spent.
Yep.
So the balance of the purchase price, which if my math serves me right without a calculator, is $400,000.
It's a big test and you've nailed it, mate. Well done.
I was starting to sweat.
Yeah.
And that $400,000 is Goodwill. And that is the premium over and above the tangible assets that you're paying for. It's essentially the hard work premium. Yeah. The systems, the IP, the customers that the business owners built up over time, all of that stuff, that the branding, it could be, I don't want to name businesses, but, there could be businesses that people out there look and they go, oh, I've got, that's a cool business because of its name.
nextAdvisory is good.
Oh, mate, why didn't I think of nextAdvisory? Struth, people just must see that logo and think, man, that's an investable business.
Yeah.
So you look at that, that's the Goodwill piece that's intangible.
Heartland Bank is probably the other, sorry.
Shout out to Heartland Bank.
Yeah. They're going to get in touch eventually and say, stop fucking talking about our bank.
Hashtag not sponsored.
No. The brand, sorry. Yeah.
So that's that $400,000 of Goodwill is the fluffy stuff, if you want to call it that. Now, that breakdown of the $1 million is important for accountants because we go into nerd mode because it then comes into the structuring of the purchase price.
Yeah.
And there's different tax treatments for each of those three components. I don't know if you want me to go into the detail, but like we touched on in the first episode, the purchase price and how you pay for it is all up for negotiation. Even the split of the purchase price between its different components, negotiate on it because the tax treatment is different across all three of them.
I explained to a client yesterday in a different business to this widget business, say, but basically a business that is, let's say, it is recurring membership income and then some equipment. That's it. And they were trying to work out how to put together a sale price of this business. And I said, well, you're going to need to get some advice, but at a high level, the purchaser is going to want a higher value of the equipment because they're then going to depreciate that, which creates a depreciation expense, tax deductible expense, decreases profit, therefore your tax. Whereas the seller, your equipment, you might think it's worth $100K, but on your books, it's now depreciated down to, after wear and tear, down to about $40,000. If you say that it's worth $100,000 in that, you're going to have depreciation recovered of $60,000. So that's basically, we've claimed depreciation to decrease the value of our assets down to $40,000. We're now selling them for $100,000. We've claimed too much depreciation. So I said there's always a bit of a seesaw between the buyer and the seller. But for this business, they weren't too concerned about that because they just want to get to the end of the sale and they just want to basically put it together where the purchaser will purchase it. So it's
spot on.
And that's where you need individual advice because a generic piece of advice like that off the internet may not be as applicable to you because that's $60,000 of depreciation recovered, which a lawyer might say, oh, don't pay that, you don't want to do that. And what a waste. Then you're having to pay tax on that. It might be, well, if that's the difference between selling this and not, then let's get on with it.
And I think that highlights the importance, and again, drawing on what we talked about in part one around you can do the whole business purchase process completely on your own without any external support. But this is where the value of external advisors like lawyers and accountants can have its benefits and merits, is you can leverage off of them to ask the questions and go, well, hey, look, I'm buying this business for $1 million. This is how it's split. What's your advice? And then they can come along and go, hey, look, have you considered this? Have you considered that? Yeah. Because structuring the transaction overall, you need that input from those specialists to make sure that you're getting all of the advantages that you possibly can.
Another simple example, mate, I saw a friend of mine actually who built up a business purely off of Instagram, but then needed some equipment and they would hire out that equipment. And someone knocked eventually and said, hey, is this business for sale, in the DM? And they were basically like, not really, but, tell us more. And they just outright said, hey, we'll give you 6 figures for it. And they said, what do we get for that? And they're like, well, you can have the equipment, and that's worth X, Y, Z, but the rest of it's Goodwill. And a massive chunk of it was purely Goodwill. And part of that was then, okay, well, we want the Instagram account, we want the databases, and we want to know if there's an email platform so we can take that over and maybe remarket or resell to those people again if they've already spent with you once. Can we have all of that? Said, yep, no worries, parcelled it all up. Off you go. Happy days. So most of that transaction is a tax-free gain for them because, they've structured it well and weren't really selling much except for Goodwill that they'd built up.
Nice.
So got a pretty decent sale there. So then going back to the widget business, so you've got plant, widgets, and then intangible. I guess that's then when, say you're then the purchaser, you're going to take that to the bank that's helping you get into the business, and you may be able to then borrow specifically against some of that plant and even some of that stock, right?
Smart, yeah. Absolutely. The bank will look at that and go, man, you've got some absolute superb top-of-the-line plant and equipment there, that $400,000. So when it comes to borrowing the $1 million, if you're going to borrow the full purchase price or even part of it, we can structure the loan to be secured over that plant and equipment specifically. That's one way to do it, and by doing that and giving a specific security over that plant and equipment could get you different rates on the loan. And this is where getting post-due diligence or towards the end of due diligence, you need to start to involve a finance person. They're much smarter than accountants are at how to structure it and the types of finance products that are out there and how to do it. But broadly speaking, if you're not using a house as security and able to get housing lending, business lending, when you go to buy a business, is typically amortized or paid back over a 5 to 7, maybe if you push your luck, a 10-year period at the absolute most. So a house, you can get a mortgage for 20, 25, even 30 years. With a business, the expectation from the bank is that the debt is paid back in about 7 years on average.
Ooh.
So think about that on going, yep, no, I can afford $1 million because I'm going to pay my housing rates at it, and over 30 years, no, that's not a problem. And when you come to do a business, one, the interest rate's going to be different because the risk is different and the repayment terms are completely different as well.
Yeah, so usually the interest rate's higher in business because the risk is that it fails, unlike property in New Zealand, mate.
Oh, yes.
So then
doubles every 10 years?
Yeah, that's the rule. You're then going to have to pay a higher rate. So you really are going to have to understand that side. And I did enjoy, someone didn't ask a question, but they said, tell these people to put some skin in the game, not just use other people's money. But most of these that you deal with, people are bringing a form of payment to the table, right? It's quite rare that they basically debt finance the whole thing.
Or it's split.
What do you reckon the split would be?
My gut says to me there's a gross amount that are 100% backed by property with very little skin in the game. But the skin in the game for them is their house is on the line. Yeah. So, and sometimes with these, if we reference the corporate corpses, they might have got to the C-suite position and they've already got the batch, the boat, and the BMW, the 3 Bs of life. So critically important. And they go, you know what, we'll put the batch on the line. We've still got the family home, so if the business does go tits up, that's our security blanket. We can let go of the batch. Could be tough, but we've still got the family home. It's
key there, though, is they've built up equity in that property first, right?
Yeah, totally. They've built up equity that they can leverage off of, that the bank will go, not a problem. We can take that as security to then give you more money that you can go out and buy a business.
Yeah. So individually, if you're going to buy a business, you need to understand how bankable you actually are. So much like when you go to buy a property, it might be your first home in New Zealand, people will lean on a mortgage advisor to figure out what do I need to do in order to be able to do that. There's nothing wrong with flicking off an email to a commercial bank manager and say, hey, I would like to think about buying a business. Here's my financial situation. If you don't know that, well, you've got some work to do to start with to figure out, here's my assets, here's my liabilities, here's what my income looks like at the moment, here's what I can save and stuff, and say, this is what it looks like. Would it be possible to buy a business? They might just say, no, get out of here. And, well, then you need to ask, well, what do I need to do to improve that? And that's where you're going to start to have some of those conversations around how you yourself become bankable to a bank that may want to support you through a bank purchase.
That reminds me of another example. Through the business buying process, understand the incentives that are at play.
Oh, yeah.
So the vendor wants to sell because they want to cash out. And the broker's been engaged because, like a real estate agent, they're the middleman, and most of them are pretty good at the job, but they're incentivized to get the business sold because they're going to collect a commission. More often than not, you're going to need finance for the purchase, and you would go through, in most cases that we see, you go through a broker. In some cases, people are going direct to bank, but in any case, the broker or the banker are going to be incentivized to write debt. So a broker, again, is going to get a commission from the bank on the debt that they lend, or the banker on the other side is going to have targets of debt that they write because they're presumably going to have a bonus on the line or some form of reward, promotion maybe, who knows, or an extra week's annual leave. I don't know.
New title.
Hey?
New title.
Yeah, hunting that C-suite, right?
Yeah.
So the benefit, and this is where due diligence comes in, the lawyer and the accountant have got no interest in the transaction whatsoever. And I like to be able to hand on heart say to clients, yep, my interest in this is obviously getting paid, but whether you buy this business or not doesn't impact me. Yes, if you buy this business, hopefully you'd come on as an accounting client and we can carry on forwards for years to come, da-da-da-da-da. But understand the incentives at play. And there was one deal, would have been last year or the year before, where there was a business for sale. We were doing some initial work for a client that was looking at buying a business, and on paper, absolutely stacked up. And they were pretty much down the path of going, yeah, we're going to buy this. We just want you to do the due diligence. And I said this exact thing about understanding the incentives at play. And I said, well, you're financing this. The house is on the line. Here's the repayments. Yes, this is what the forecasts that the vendor has produced, and you have updated those forecasts based on your position. Have you also factored in the debt repayments and the serviceability on these numbers? And all of a sudden there was just silence. And then I was like, okay, now factor in what would have happened if there was a 10% reduction or a 20% reduction in these numbers at the top line, and how's that going to impact your cash flow and therefore your serviceability of this debt? Because they were borrowing a huge amount of money, and they were really keen on it, but they were slightly risk averse. They backed away from it. Because they looked at the numbers and they were just like, holy moly, there's actually not a lot of room for margin of error in here, that even if there's a slight decrease in performance of the business, the debt becomes unaffordable. And that was a real wake-up call. Like the business broker or the banker on the other side was like, yeah, we can do this, da-da-da-da-da. And I think the risk is they were potentially distracted by their own personal incentive or interest in the transaction. And we're trying to sell the upside rather than going, how do we protect our client? And come along and go, and they ultimately walked away from it.
Wow. I think it's a good point to make, that the vendor, the broker, and the banker are all they got to get paid somehow. So just be mindful of that, how people are making their cash. We've touched on this kind of how to make sure it meets the sniff test financially, and then that sort of ties in how to look out for what it's worth. We talked about that a little bit in the first version or episode as such, so you can probably go back and listen to that if you haven't already as well, but you can get a business valued.
Yeah, that's what I say. The sniff test would come in two parts. It's funny that they reference the sniff test. That sounds like my language, but I didn't ask that question. We'll come in two parts. Firstly, the valuation, does it pass that test? And then secondly, when you go through to do your financial analysis, is there anything in there that smells off?
Yeah, simple as that. The next one is what...
I think, sorry, just coming back to that is And it kind of reminds me of meetings that we've had with clients or business owners in the past, and not clients, where they give you financial information.
Yeah.
You know where this is going already.
Yeah.
And they say to you, what can you see? What can you tell us? You know, and I think if you're new to business or don't have any understanding that somebody with a financial background like an accountant can basically look at a set of numbers and be able to immediately tell you whether it's good or bad, the short answer is you can't, because those numbers need context. So gross profit year on year might be really stable for the business that you're looking at. Great. But what are the components that are taken into account with gross profit? And we've got to make sure we're comparing apples with other businesses. There's data out there to go, and I can't remember what website it is, but there's it's not Statistics New Zealand, maybe it is, where you can get like industry data. But you could ask around and go, well, is 30% year on year, that's stable, that's good, but in the context of the wider industry and making sure that we're taking the same components of cost of goods sold, how does that stack up? Then once we're putting it into context, we can then go, yeah, that's good, or no, it's not.
Yeah. Yeah, and again, you're not going to have all of the complete information, but that's part of any investment, whether it's into a stock on the NZX or US stock market or a business that you're buying. We're always investing without the complete information, and that's where the risk piece comes in.
Yeah.
But then it's what you can do on the other side to de-risk it, because you could do the best sniff test you've ever done and something could still come up a bit fishy on the other side, because you just don't know about it until the machine breaks down in 18 months' time, and then you realise, oh, wow, 12 months ago when we brought this, for instance, the part, we could get it here, but now we can't because that business went under, and we didn't even think about that when doing our due diligence, for instance, because it's just not something that you'll think about, or we have a pandemic or whatever, and then you're in the trench anyway and having to figure out, okay, well, how do I protect this investment that I've made?
Conscious of not wanting to go onto a tangent, but I'm so curious as to what your sniff test for Heartland Bank was, or you just take that you buy it because you like it approach.
Yeah, mostly that. It's too emotional. Now, my sniff test, mate, was basically the boomers are getting older. They've got all their equity tied up in their houses. Heartland Bank's one of the only banks that was offering a reverse mortgage. The market's not educated yet. If they can educate the market, the boomers get educated. The boomers take the reverse mortgages. Heartland increase their profits. Luke gets paid his dividend. Happy days.
Yeah, right. So you're basically investing into their marketing team.
Yeah.
Yeah.
Just not quite seeing the gains at the moment.
Right. Do you know who's on their marketing team?
No idea.
Great sniff test.
Yeah. So my due diligence people, not amazing. Yeah. But it's a long-term play, you see. So I'll stay in the trench and I'll see how I go with that. And by that time, probably the bigger banks will offer reverse mortgages and
Oh, and in that time, you would have got your 51% and it'll be your bank.
Perfect.
And you'll be able to rebrand it, sure.
Yeah. Then we could just start giving out some loans for people to start businesses.
Yes.
Yeah. Happy days. What to look out for when buying into something in chunks. So I assume this might be someone who is buying into a business that maybe they're involved with, maybe as an employee, for instance, or they've been told you can buy 20, 20, 20, 20. Any thoughts in that space?
That's a different kettle of fish altogether, and it's not often that we'd get involved in due diligence for those kinds of businesses, because typically as an employee, you're going to have a really intimate understanding, and assuming that is the case, right? So for context, you work in a business and have been offered a portion of shares. The business owner is looking at you as part of their succession plan, that over time you're going to ultimately buy the business off of them, and it's going to happen in chunks. You'll already have such a massive understanding of how that business works. It probably would pay to do some level of due diligence to understand the financial aspects, because yes, you can appreciate the non-financial stuff, but you've got to have that financial literacy of what's actually happening on the P&L, on the balance sheet. The biggest thing with it is when you're in that position and you're buying it in chunks over time is establishing value. How much is this business worth? And if I buy 10% or 20% or whatever it is, and then there's another 20%, what's it worth? What's it going to cost me? And then the second part of that is going to be, how am I going to pay for it? And referencing again back to the first pod, like buying a business, there's a stack load of ways you can skin a cat, and it's no different if you're an employee looking to buy in. You can pay your boss, presumably it's your boss, cash up front for their shares. You could borrow money from a bank and give it to your boss. You could, the company in some cases can lend you money to buy those shares. You could get a loan from your boss to buy the shares. And then again, if you're getting loans, how are they paid for? Well, if you get it from the bank's going to tell you how it wants its cash back. If it's through you and the business or you and your boss, you can set the terms to suit. How much is interest? Is it interest-free? Repayable out of dividends. So essentially you're just forgoing receiving the dividend in cash to then ultimately just put back and pay off the loan. There's a stack load of ways of doing that. But yeah, the main thing would be making sure that you're committed to this business for the long term. And again, a reference back to what we talked about a little bit in the first episode on this was an employee can look at buying into a business with rose-tinted glasses. Like all of a sudden, you've got a boss who's got 100% and then you're coming in at 10%. The reality of it is you become a 10% shareholder, your life is no different. It's not like you're going to walk through the door on the Monday after becoming a shareholder and you've got a different hat and you've got this puffed up chest and ego. You're still an employee. 10% is not a lot. You got to get over 25%, I think it is, 26% to actually start and have any kind of impact on decision making at a director level. And that's really only with major purchases and strategy. Then you've really got to get to 51% before it's ultimately yours because it's a controlling interest.
Yeah.
Until then, you're still an employee. And I've seen cases before where relationships have burnt and it's all just turned to custard because the employee has come on as a shareholder thinking that their life is going to be different and their attitude's changed, and all of a sudden it's just turned to custard and the relationship breaks down and they exit. You want to avoid that because it's costly.
Yeah.
If you're the one thing that you must do, it's not negotiable. If you're an employee buying into a business and your boss will also want the same thing, you got to have a shareholders agreement. That's non-negotiable.
Yeah, I was going to say you could almost start with some of the conversations too around, say you're going to buy into it, go further down the path and worst case scenario and say, what if I need to get out of this business?
Yep.
You have a change in circumstance, disagreement in the relationship, you've got to cover off the exit when you're covering off the entry. Yeah. It's much like when you first get on the plane, mate. They still tell you, get off that bad boy.
Yeah. Count the number of rows.
Yeah.
Yeah.
So same thing. And also try and be clear with the person who you're buying into this business with. What does the future look like? And are they just going to sell some off and go, great, we've freed up some cash and now we can take our foot off the gas, and all of a sudden you're thinking, whoa, hang on, I thought we were about to double down. So you want to have some of those conversations. We've seen people going through that recently. But I was going to say as well, just because some people, we get the insight to, I'd say, over thousands of businesses now through our careers, right? But would you agree that most businesses don't make the revenue that people probably think they do, nor the profit that other people think they do?
110%.
Yeah.
And I'll go a step further, and they don't have the cash in the bank that you think that they've got.
Yeah. I think
it would probably be the other way. They don't have the cash because there'll be a bank overdraft there.
I reckon part of what's happened is that, just like anything, it's been very easy to finance flash-looking things. So employees and people who aren't in business, for instance, we might get buy now, pay later, credit cards, and so we can make our life look a bit better than what it actually is. In business, it's very easy to finance a European car once you've got a couple of runs on the board and someone's incentivized to sell you that debt.
Guilty.
So we can do that stuff. So I think we see business owners living this different life to what we might be able to get access to finance-wise, and we go like, oh, okay, they're obviously doing really well. or we see them take a week off, but we forget that they work 4 hours each night or on their weekends. So we don't think about what their lives are like compared to ours, and we just assume, well, shit, they took another day off or whatever. And you start to build up this image in your head that isn't even real until you get the data, and then you finally get the profit and loss, and you realise, I thought every business in New Zealand turned over $1 million. What's going on here? But only 15% of businesses in New Zealand do that. So you start to get some lessons of, everything that I thought may be real may not be real. And the one thing that I think a lot of employees will never think about is that you don't know what debt the business owner is running up with the IRD, because it's just not something that we individually think about. So you may find that the business is actually behind on payments to the IRD for GST, for PAYE, and this is happening in record numbers at the moment. Or there might be a loan from a third-tier lender that's helping the business get through, and your whole picture of what you thought this business was just might not even be close to the reality of what's happening for that business owner.
Spot on, and I'm probably preempting one of your next questions, and that's the difference between buying the assets of a business versus buying the shares of a business.
Yeah.
And when you're buying the assets of a business, that's coming back to that earlier reference where you're buying a business for $1 million and there's plant and equipment of what did we say it was, 400,000, the widgets 200, and then Goodwill. That's an asset purchase. You're buying the pieces of that business that you can then take control of that are going to generate the income into the future, and you're going to structure that into whatever company or partnership or whatever vehicle you want to use that suits your circumstances. A share purchase, on the other hand, completely different kettle of fish. The majority of business purchases that we see are asset sales, and it's what we strongly encourage our clients to do. On the flip side, where that's not possible is if you are an employee and you're wanting to, like what you were talking about before, you're buying into a business and you're talking about the debt. So if you're an employee and then all of a sudden you're going, yep, great, man, this is the best business I've ever worked at. Yep, Luke and Phil are great. I want to own part of Next Advisory, da-da-da-da-da-da. Next minute, you start and do your due diligence and you look at the balance sheet. So it's not Next Advisory, but let's say it's another business. And to your point on IRD, that's debt. And particularly if it's PAYE debt, so the company has paid you your salary, deducted your tax to then pass on to the IRD, but then they've gone and spent that. They might have taken it out as drawings to go and buy the European car or buy the batch. They might have put it into something else because, well, just working capital because one of their customers isn't paying them. Like there's all these risks there, but they're racking up debt to the IRD, and PAYE hands down is one of the worst taxes you can get behind on. If you're coming in as a shareholder, you're taking over a portion of the balance sheet. So the balance sheet are the assets and the liabilities of the business. So it's not just this bite of the assets that you're taking, you're also taking a bite of the liabilities. So it's really important to be mindful and understand what is the liability position of the balance sheet. It's so easy to look at it and go, it's a great asset. We do all these cool things. It's got branded cars. We've got a great brand. It's full of goodwill. All of this cool stuff. We've got the rose-tinted glasses on. But beneath all of that, we're racking up debt to the bank, the IRD, Prosper loans, Harmony loans, BNZ loans, ASB loans.
Heartland loans.
Heartland loans. Yeah, we've got to get them in there. Shameless plug.
Yeah.
So I think it's important to understand that you do some level as a due diligence as an employee to go, what am I actually buying into? Because you've got to think about it from this way. If you were to put the money in yourself, so actual skin in the game, and let's say you've got $200,000 to invest, that's a lot of money by anyone's stretch of the imagination. If you had that in cash and you had the choice of putting that into the company that you're working for or into, I was going to say Heartland Bank, but we want something we want something profitable.
The defamation claims.
I don't know the results at Heartland, but let's assume that Bank X is incredibly profitable and you could put $200,000 into that business and buy the shares on the stock exchange. You're going to get a return by way of a dividend, and the dividend might be paid quarterly or it might be paid 6 monthly, who knows, but there's going to be a dividend, and it's going to be well run because they've got a great management team, so you're going to expect some level of capital growth as well. So that means the price of the shares is going to go up over a period of time. If you put that $200,000 into the company that you work for, doesn't necessarily mean that you're going to get a dividend and that there's going to be a capital return on it. What are the risks in there that you don't understand? You could be handing over $200,000 to ultimately lose it, compared to something that's a lot more secure on the other side being Bank X.
Yeah.
But that's not to say that putting $200,000 into the company that you work for and wanting to take over as a shareholder, we're not discouraging that, just saying go in fully informed and making sure that, cash has got an opportunity cost. We can either go and spend $200,000 on buying a business, or we can go and spend $200,000 on buying a Porsche. Most people will go, we'll buy the business because we want to build our asset base. This is what this podcast is about, right?
Yeah, I don't know if most people would.
I'm fighting the answer here, mate. Yeah. But in terms of building the asset base, you want to get a return on that capital that you've put in, and it comes with an opportunity cost. You're having to choose something over another option. So when you're choosing between options, you've got to make sure that the option that you pick is ticking your boxes. It comes back to that sniff test.
Over the last couple of pods as well, you've mentioned, and I think it's worth pointing out again, you might put your $200,000 into that business, but remember, it could be quite illiquid, so it might be hard to get that out because you've got to then find someone who can buy you out. The current business owner, if you don't cover that off in a shareholders agreement, that could be tricky, and then someone else may just not want to buy into that business, and so you're going to have your cash tied up there for a while. So
life, and you got to be absolute darn sure that the company that you're an employee and wanting to become a shareholder of and go on the journey, so you're starting off at 10, get to 20, and so on, that you're in for the long haul. I was going to say it's kind of like marriage, but you can get divorced pretty easily these days. Having a business is not the same. Like, once you're in, and it's bloody hard to get out of, like you just mentioned.
I think this really highlights the importance of getting good quality advice, whether it's legal, accounting, in this space, because the difference between buying the assets of a business and or the shares is massive. But people just look at it as, I'm buying the business. And, you could ask them, are you buying the assets or the shares? And they're basically like, I don't know, because they haven't even thought of that. But those are two completely separate, different paths. Just one thing as well, normally when you sell a business and then therefore someone buys on the other side, it's sold as a going concern when it's not the shares. And so basically there's no GST or zero rated for that transaction, right?
Spot on.
So there isn't a GST payment because someone asked, if I just sell the assets, am I going to have to sell... am I going to have to pay GST? Because I don't think my business has any goodwill, and I think they were getting themselves confused. But I think it just reminds me of a good point as well, that with the GST side of things, your accountant and your lawyer will give you some advice around that. But normally businesses are sold at a going concern because that basically means that you as the buyer are going to continue to run that business. But again, you need to get GST advice around this stuff.
Yeah, and that will definitely be in an asset sale. It'll be on the sale and purchase agreement, and it'll say on there the purchase price is inclusive or exclusive of GST, if any, and your advisors will give you the right advice to make sure that you're doing everything that you need to do. Because if you get it wrong, the worst thing that could possibly happen is IRD review the transaction and they go, this isn't right, and then you need to pay the GST to the vendor, which the vendor's then ultimately going to pass on to the IRD, and you're going, well, okay, they're not getting any benefit out of it. What needs to be highlighted there is you all of a sudden need to come up with 15% of the purchase price in cash from somewhere. If you've bought the business for $1 million, where's $150,000 going to come from?
Yeah. Brutal. Yeah. Last one, mate. We better get out of here because we've gone past the hour mark. We're flying.
Truth.
But it just shows how broad this topic is. But this one says good businesses to get into. Now, I'll give a couple of thoughts and then you can probably overlay some better ones as well. But from my side, thinking about that, if I were buying a business, I'd want to be buying a business in an area that I know a lot about and that I'm heavily interested in, and that I can look at it and go, I can figure out how to add value to that for the next 10 years. Not some fatty shit that I saw my mate doing and think like, oh yeah, it'd be great to sell cupcakes as well. And if, you know, this person can do it, then I can too. And I saw one's for sale, so I might do that. That's a very good way to risk a lot of money and a time of your life that you could actually be spending in growing wealth and also, you know, adding to your own skill set and building up an asset that you can then sell in the future as well. So take this stuff seriously.
Yeah, I think you're spot on there. I don't think there's one particular type of business that's going to be better than anything else. I mean, I could put my personal bias on here and say there's types of businesses that I wouldn't buy, but I won't mention those because people could look at it and go, well, what do you know? Because I know blah, blah, blah about this particular industry and I find it quite easy.
Yeah.
I think it comes back to the point that you raised is, what value can I add to this business? And then I look more broadly and go, what are the likely larger economic impacts to this industry, not only in New Zealand but globally? What are the risks in the future to a business like this that could disrupt it? I mean, you only have to look back 20 odd years and Blockbuster was the biggest video chain. Next minute, the internet comes along and destroys that business. And Netflix has just taken everything over through streaming. Would have never have guessed something like that unless you're like in that Netflix space. But you got to look at those kind of risks and go, in the heat of the moment, are there opportunities where you can mitigate that risk and diversify? Absolutely, there can be. But I think every business has got elements of it that are good. You've just got to be able to see the potential in it and the opportunity and be prepared to roll up your sleeves and dive in.
On the economic piece, you know, for instance, to keep it simple, you might be looking at a business that does business cards for people. And what did we do when we got one the other day? We both laughed the next day. Like, did you put your one in the bin?
Yeah.
Yeah. And 20 years ago, or even 10, that might have still been something that you think, okay, that's a good business and it can make a bit of money. But things like Vistaprint came along and you could go online and make 300 of them in 24 hours and get them sent to you, and you could almost be the CEO of your own company with your business card. But at the end of the day, do people really give a shit about your business card? The answer is still no, but that stuff is fatty and will pop up. Then it's like the electronic one and here's my metal one and whatnot. So they can look really cool and sexy because they become innovative. But do you really want to be selling business cards, you know, for the next 5 or 10 years? And then who's going to buy that?
Funny you mentioned that, because you've probably seen, but on my desk, my stack of business cards. And
I've got one up here, mate. Somewhere.
Yeah, up the top there, I noticed that. Yeah. And geez, I haven't seen the back of our business cards since we probably got those produced, and like the what's next, and it's got the check boxes, and I can't even remember what they say.
Yeah. Chat beer winning something, I don't know.
Yeah, and the stack of business cards that I've got there would be at least a full box's worth, and they're as old as our business.
Yeah.
And I cannot remember for the life of me when I last gave one out, and no one has certainly ever asked me for one. But funny that you mentioned the one where we both got one. Next day, what'd you do with it? In the bin. To contrast that, I got a business card, and I think you might have got one as well from a particular business owner in the office, and I made a comment to them, because this business card was like, if there's business cards, it was like 5-star. Like most business cards, you'd be lucky if they were 1-star. I mean, ours, we thought they were cool. They're probably maybe 2 or 3 stars. But
we spent so much time on those business
we did
cards.
The cut edges and then the printing on the back and just everything. We could get so emotionally involved in for something that no one gives a shit about. But this business owner gave us their business cards, and we was like, whoa, what the fuck are these printed out of? Yeah. It was like premium, and they felt good, and they were heavy. I mean, it still went in the bin, is the reality of the situation, but I remember that person's name.
Nice. Yeah. Yeah, and it's a good point. You've got to be doing something really innovative if the economy and the trend and vibe is basically going directly against you. So that's why I think it's really, really important to seek individual advice to get some of the insight to things that you just won't think about. But, you know, for us, for instance, a couple of years into our journey, when we say we saw someone that was doing business cards, we had first-hand experience of like, oh man, we went down this path. It's just not like, it's just not a thing anymore.
Yeah.
And sometimes you have to spend some money on things to realize, yeah, I don't want to do it. So going back to the start was basically make an inquiry. If you want to figure out a good business to get into, maybe become a customer of it and see and strip out emotion and figure out, do I know a lot about this? Could I do things differently? Start collecting the information and make sure it's something that you actually want to do. Because whether you are employed or running a business, most of us still trade our days for our goals. So it's got to be worth it. Otherwise, what's the point, right? So make sure it is actually something that you're interested in.
And I think probably the final thing I'd say on that point is, in terms of what's a good business, and it's the simplest but most often I think overlooked one, is just talk to people. Go out there and talk to business owners in different industries and say, what do you like about this business? What don't you like about it? What are some of the challenges that you're faced with? I'd like to understand your industry more. What can you tell me about it? Be interested, and that other person will just puff their chest out and tell you almost everything that there is to know about their business, because they are going to love talking about it.
And on that as well, there could be a similar business that isn't for sale in a different part of the country that you can ring and say, hey, I'm thinking about buying a XYZ type business. I just wanted to ask from the horse's mouth, what's it like running one of these businesses? From someone that's not, selling their business, what would you say? And business owners love talking about their business because
they do.
It
reminds me of the client that we had who's based in the North Island, and we said, who's somebody else in your industry? And first person they mentioned was down in the South Island. And we're like, why don't you go and meet with them and talk with them? Oh, nah. And just thought, no, they wouldn't do that. And months later went by, ultimately went down there, got the big tour, rolled out the red carpet, and these people talked, and they learnt lessons that they could go away and then ultimately put into their business.
Yeah, so powerful. And I think something that we overlook because I want to figure it out for myself, and that Kiwi number 8 wire. And I think probably a similar business that you're talking about, they go down once a year now to compare notes with a competitor, but they're not really a competitor because they're in completely different parts of the country. But they then share best practice and writing policies and procedures and stuff like that. So that's all the fun stuff you get to do once you buy a business or start a business, if that's your thing. But again, mate, thank you. We've cracked.
Yes, we've absolutely smashed the 60 minutes. Hopefully people are still tuned in at this point. There is a lot of ground covered, and I'm sure there's a stackload more questions out there. And I think if anyone's got anything that they would like to ask, obviously they can get in touch.
Yeah, for sure. And I'll try and see if we can put a link to that checklist for people to download should they want that. But Phil at nextAdvisory.nz, or jump on our website if you do want to have a chat. Please, this is a big audience now. Don't waste Phil's time and just send him query after query because you're trying to get the answers without actually being keen on doing something in this space. But I thought it'd be a good place to start, mate, because you are a wealth of knowledge in this, and you've advised countless business owners who have gone from not knowing anything about getting into business to now owning and running a business. So I'm sure that will probably just spark another 1,000 questions from people out there. And
hopefully that means we've done the job, right? Yeah, no, thanks for having me. Been a pleasure.
And then we'll do a part 3.
Oh, happy days.